We're gonna talk about one of my favorite topics in the world of investing, and it's bonds. And it's not my favorite because because I think bonds are a really great investment instrument. You're actually going to see as we go through this, you can hear in the background. I don't know if you're catching my daughter, but she's not a big fan of bonds either. She gets real riled up and angry whenever I get going on bonds, but there's a lot to this topic. And the reason that I was really so excited to do this topic this week is because I've had about, I would say, 7 or 8 conversations in the last couple of weeks with people that it was just obvious to me needed more tools to talk about bonds. They had really good overall understanding of investing, really good overall understanding of like taxes and different things like that. But when it came to their bond portfolio, in my opinion, they were being misled in terms of the type of performance they were getting out of the portfolio, the type of performance they could expect going forward out of that portfolio, how that portfolio was performing in general, some of the risks in that portfolio. And what I'm really just trying to do here, we're going to probably revisit this and do a more advanced bonds class. But right now, this is really more just the absolute basics, fundamentals on bonds. For all of you watching, if you're watching this in our retirement mastery group, feel free to jump in with questions. I have my phone running over here that should be getting me all the comments and questions and things like that. I want this one to be really, have a really open dialogue about bonds. I do have quite a bit prepared that I want to share, but if you're watching this on YouTube, thanks so much for subscribing to the YouTube channel. Let's go ahead and dive in and get going on this. So first off, what is a bond? A bond is a certificate that's issued by a government or a company promising to repay borrowed money plus a rate of interest over a specified period of time. So, for example, let's say, you can pick a company. It could be a fictional company. Ford has bonds, Oshkosh Corporation, all these big major corporations out there that have bonds. It works like this. The bond investor gives up principal. So the bond investor gives up cash, this stack of green dollar bills up here in the left. That's what the investor gives up. The company gives up a promissory note. Basically, the bond itself almost acts as like the mortgage or the promissory note, meaning this is how much we're going to pay you over this amount of time. And we'll come back to that. Here we go. So we're going to pay you this much interest over this period. It might be every 6 months over this amount of time. Might be a 10-year bond, might be longer, might be shorter. There's all different types. But at the beginning, when the bond is created, this is called issue. So at issue, that means basically when the bond is born, that's when we are that's what we're talking about here. It is money going to the company as a loan. That company is issuing a promise to pay back that money. So let's go through time. You're the bond investor. You're collecting interest. You might be wondering, when do I get my money back? Well, these coupon payments along the way, I should mention this is kind of a key term when it comes to bonds. Those interest payments you're getting are called coupon payments. And a lot of people wonder, what does coupon mean? Well, it actually used to be back in the day, if you had a bond, you actually had to clip little coupons off of that bond, send them in, and then the company would send you your interest payment that you were owed. So that's where the phrase comes from. Coupon basically is like an interest payment. Okay. It's kind of a relic. It's a little bit of an artifact from an older time when we actually had to send in coupons to get those interest payments. Nowadays, you don't have to worry about any of that. There's just your coupon, your interest payments are just coming in at maturity. So throughout, let's say it's a 10-year bond, they make an interest payment to you every 6 months, and then at the end of the period, the very last payment, they give you the 6-month interest payment for the last 6 months. And they also give you back your principal value, your original value. So when they pay you back that principal, that is called par value or face value. So in most bonds, that'll be something like $1,000 or $10,000. I actually have a bond in my office here somewhere. I was trying to look for it before the presentation, but it's a $50,000 face value bond. That means if you hold the bond until the maturity date, you get $50,000 back with the last principal payment. So that date that bond matures, maturity date, that's when you get that principal payment back. So the thing about bonds is that they trade freely. So over at the beginning on the left here, that's at issue when the bond is created. And then at maturity, you get all your principal back. But in the meantime, bonds can trade higher or lower than the face value. So we're going to talk a lot about this because it's going to have to be. This is a much more nuanced conversation when we get into the whole premium discount factor in regards to bonds, because I think this is the real disconnect in the bond market. People don't understand right now how much of a premium they're paying for bonds and how little their overall yield is going to be. So stick with me. I know I'm using some jargon here, but this is going to make a lot more sense in just a couple of minutes. So a lot of people will see this and they'll say, wait a minute, why would a bond trade at a discount? If I'm going to get $1,000 for that bond at the end, why would it only trade for $800 or $900 today? And there's a bunch of reasons, but let's talk about the main two. So the first one is credit risk. So let's say that company might not pay back their loan. Let's say it's a company with a whole lot of bonds outstanding, a whole lot of debt. They're almost out of cash. Let's say like an Evergrande situation in China where the government comes in and changes a rule. And all of a sudden, suddenly that company's really cash strapped, can't come up with the cash to make their interest payment. Those bond investors are going to want to sell if they own that bond. Let's say this is a bond. I'm going to actually just make this really quick. So this is a bond. It's got $1,000 face value, $1,000 par value. I'm the owner of this bond. When my financial situation, I already screwed it up. Back up, reset. I got $1,000 bond here that we're going to say this is from ABC Corporation. So I'm going to write this on here too. It's from ABC Corporation. They owe me $1,000 at maturity date. If ABC Corporation's financial situation deteriorates, like let's say I live near their factory, and as I'm driving by, I'm seeing they're laying people off. I'm seeing the building crumble and fall apart. I'm seeing, not a lot of orders going out, different things like that. I might start to wonder, hey, am I ever going to see this $1,000? The bond itself is really just an IOU. That's all this is. It's literally like in Dumb and Dumber when they're like, these are IOUs. They're better than cash. That's a similar thing with the bond. This is just a promise that they're going to pay me back. So if that company fails, I don't get this back. In fact, what happens is the stockholders get wiped out. The bondholders move to the front of the line, but there's all sorts of different classes of bonds. So like a senior mortgage would be the most likely to get all their money back, all the way down to like a junior unsecured debt, junior unsecured bond, that which will be called like debentures and different things. You don't need to know all the terminology on this. Just know that like the more risk that there is of you not getting your money back, the more likely it is that bond is going to trade below what that face value says. So even though it says $1,000 on there, I might be able to buy this bond for $800 if there's some risk that company might not be able to make that $1,000 principal payment at the end. Okay, so that comes up a little bit, but to be quite frank, that's not the main reason bonds trade at a discount. Typically, when you look at like across a market, when 10,000 bonds that are out there from all sorts of different companies, all sorts of different, periods and lengths of time and everything, the main reason a bond will trade at a discount is because interest rates are higher than when that bond was issued. So let's look at this for a minute. Bonds and interest rates move in opposite directions. Okay. And I'm going to go through an example in just a minute that I think really helps make this clearer. But what you need to know right now is that when interest rates go up, bond values go down and vice versa. When interest rates go down, bond values go up. So if let's say at the time that I buy this bond, interest rates are at 3%. Okay. So this I'll zoom this way in. So this 3% means they're going to pay me $30 a year while I own this bond. And then at maturity, I'm going to get my $1,000 back. If interest rates go up in the future, where now I can get $40, let's say interest rates go up to 4%, and I can now get $40 for my same $1,000 investment, an investor is not going to be willing to pay me $1,000 today to make just $30. Okay, so I'm going to do another example here, just right on the screen, just because this is a really critical concept when you talk about bonds, premiums and discounts. If that one wasn't making sense to you, let's just try it from a totally different example. So you pay this one's more extreme. So you pay $1,000 for a bond. Okay, it's a debt from a company. That company is going to pay you 1%. So that means they are going to pay you $10 per year. Now we're going to say some time passes, 4 or 5 years pass. And now rates on a similar bond are going to go to 5%. So an investor today can get $50 in income for the same $1,000 investment. So my question is, would they pay you $1,000 for that bond? And I think the answer is obvious. No, they'd pay you significantly less for that bond if they're only going to make $10 a year when they could be getting $50 a year on that same $1,000 investment. So that's what we've seen in the past. And bond values get crushed in this scenario. We're going to go through some examples here. So if interest rates pick up, right now interest rates are really, really low. If interest rates go up even slowly, what we have up here at top center, it says for interest rates rising 1%. This is not my chart. This chart comes from JP Morgan, but they say that a 2-year bond, if rates go up 1%, a 2-year bond will lose 3.5%, a 5-year bond will lose 6.6%, a municipal bond will lose 7%, 10-year bond will lose 11%, corporate bond will lose 11%, and a 30-year bond, a really long-term bond, could lose 27%. That's for a 1% rise. So I want to flip this now and talk about when a bond would trade at a premium. Okay, so credit risk improvement. What does that mean? Let's say when I originally bought this bond that was paying me 3%, it was a relatively safe company. But then over time, their business improved, their financial strength improved, they were really well managed, and they have now become just a super strong, really solid balance sheet. If bonds that are similar to really high quality, AAA rated, like super solid, like if Berkshire Hathaway was borrowing money, that type of super strong balance sheet, let's say the interest rates on that type of bond are now only 1%, my bond is going to be worth significantly more because it's a super high quality bond, super high quality company, and it's paying 3%. So what that means is I might want to sell it today to get more than $1,000. Okay, so we'll come back to this and show some examples. But if the company's risk level goes down, basically they get a lot stronger, the interest rates are going to go down, meaning the price of that bond is going to drift up. Okay, so the other way, the main reason, and what we're seeing right now in today's environment, is if interest rates go down between the time the bond was issued and today, that bond is going to trade at a premium. So a lot of times when I explain all this and I do all these drawings, usually it takes 2 or 3 or 4 different examples because bonds are a little more complex. People will go, wait a minute, does that mean if I buy a bond at a premium? So like this bond, again, it's paying 3%, and then at maturity, I get $1,000 back. Right now, if it's trading at $1,050, so $1,050, does that mean I'm paying $50 more than I'm going to get at maturity? And the answer to that is yes. Okay, now the reason you might do that is because it's paying a 3% interest rate. So you might be willing to pay a little bit more than $1,000 right now because that interest rate is $30 a year that's coming in. So what's interesting about that, though, is if we look at the entire bond market right now, so this is an ETF, iShares Core US Aggregate ETF, the ticker symbol is AGG. It tracks a whole bunch of bonds, treasury bonds, mortgage-backed securities, industrial bonds, financial bonds, utility bonds. Basically, it's kind of a ballpark estimate of all the bonds in the United States. $89 billion inside of this fund. But what you'll notice here is it says, I'm going to go to the next screen. So it says on the right here, these are the key things. So let's actually start in the top left. It says 9,807. Okay, number of holdings, 9,807. That means there's 9,807 bonds that this fund owns. So this is a lot of different bonds, everything from municipal bonds, all sorts of different things are in here. But then look at where it says on the right in the second row, it says average yield to maturity. So this is where there's a big disconnect. Okay. So if we go down 2 more lines, it says weighted average coupon, 2.84%. So What that means is the average bond that's in this portfolio has a 2.8% interest rate that it says on the bond. That's what it's going to be paying, an average coupon of 2.8%. But the yield to maturity, if we go up to that second line there, average yield to maturity of 1.4%, this is by far the most critical number in a bond portfolio. This yield to maturity is the total yield you're getting. So we take the coupon that you're getting, the interest payment that you're getting, and any potential principal value change in the bond. Those two numbers together, the coupon payment plus the possible value change in the bond, if you hold it to maturity and it pays that $1,000 back, that total yield is called yield to maturity. This represents really the actual amount of money that you're making when you own a bond. So again, yield to maturity, just to get it on the screen, is the annual return on a bond if the bond is held to maturity. It is the internal rate of return of an investment in a bond. If the investor holds the bond to maturity, the company makes all payments as scheduled, including that final principal payment where you get, the big chunk back at the end, that $1,000. So the key thing to understand here as we go back to this screen is it's possible, and I would say almost a guarantee, that the yield to maturity and the coupon are different numbers. Okay. Because if the price is significantly different than the face value of the bond at maturity, you're going to get a different yield to maturity. So what I mean by this is, let's say that this bond is going to be worth $1,000. I'm going to just kind of back up here to try to make this a little bit clearer of an example. So way out in the future, this bond is going to be worth $1,000. Today, even though it's still paying 3%, if you only got to pay, if it's trading way down here, you only got to pay $800 or $900 for it, the total yield to maturity is going to be better than 3% because you're getting the 3% interest payments, plus you're getting the price change from it going to 800 back up to face value of 1,000 at maturity. So the other way to look at this is if your bonds are trading at a premium, it's possible that even though you're getting a 3% coupon payment, your overall return as an investor in that bond is below 3% because you're paying $1,100 today and you're only going to get 1,000 back at the end. You're losing $100 over that holding period, which is kind of the case in the market right now. So I don't want you to take my word for this. I actually went to Morningstar and I typed in AGG. And again, I have no strong feelings either way about that fund. I'm not making any kind of recommendation about that fund. This is just a good proxy for the overall bond market, being that it holds almost 10,000 different bonds, all different types of bonds. What you'll notice though, is it says weighted price. Okay, weighted price 108.84. So what that means is the average bond in that fund is trading 8% above face value. So if it's $1,000 face value bond, you're paying $1,080 for it today. And over the next duration up this top number. So let's talk about duration real quick. Duration just means, in essence, the average amount of time between today and when you're going to get payments. So what I mean by that is if it's a 10-year bond, the duration won't be 10 because you're going to be getting interest payments along the way. So the average amount of time, the weighted average amount of time to the payment might be like 8 or 9 or something like that. So because you're getting these interest payments along the way, and then you get, it's really weighted heavily on the principal value because it's so much bigger than the interest payments. But in general, as a quick, real rough proxy, where it says effective duration up here, that top line under where it says fixed income measures, effective duration 6.5, that means on average, your payments, coupon payments and principal payments on average are about 6.5 years away. And you are paying $108 for every $100 worth of face value. So here's what I mean. Over the next 6.5 years, you are going to lose 8.8% of the initial investment. Okay. Now, you're getting interest payments along the way. We're only talking about principal here, but you have to look at how much of a premium you're paying today. So If it's a higher quality bond, the premium might not be quite as big, because it might have been such a low interest rate at issue that, rates haven't moved as much for it. And you might only be paying a 2% premium. And to make this an example really clear, if you were going to own a bond for 1 year and it was going to just trade, it was going to pay you to just use really simple numbers. So let's even go, I should have another sheet of paper here. And I'm going to try to use a pen that might show up a little bit better on screen. So this one is going to be a $100 bond. Okay. So, and that was actually like the opposite of what I was trying to do. I was trying to make this quite a bit darker. So this is a $100 bond. Okay. And it's going to pay you $2 in interest over the next year. So this is the face value, $100. This is what it's going to pay you in interest over the next year, $2. If this bond today, it matures 1 year from now, and at maturity, you get $100. If this bond today was trading at $102, there would really not be much of a reason to own it. So if you had to pay $102, you're going to get $2 in interest over the next year, and you're going to get $100 back at the end. That would kind of be like, that's almost like a checking account, so you would have to say that would have to be so safe, so much safer than like your bank account, that would be really why you're doing it, is to get some safety. So the good news is, in today's environment, it's not quite that bad. So you're really paying in the neighborhood of 1% or 1.5% a year more. Think about it this way. You're investing $108. They're going to pay you $2, $2.50 in interest each year, but you're going to lose about $1.50 a year in face value, because you paid 108 and it's slowly going to tick down each year. And at maturity, you're going to get $100 back. So that's just the average bond. Okay. Some bonds are better, some bonds are worse, but the average bond in the United States right now, you are paying $108 for a face value of $100, meaning you're putting in $1,000, $1,080 today to get $1,000 back on average 6.5 years from now, plus the interest payments in the meantime. So the longer out you go, so if it's more of like a 20-year bond, long-term bond, the worse this trade-off is going to work. And the key thing that I want to be clear on is, from 1981 to today, we've had pretty aggressively and pretty consistently dropping interest rates. So that's going to make bonds look a lot better than like long-term, how they've kind of played out. So if we go back to this period on the left here, where we look at like from the end of World War II up through 1981, you saw rising interest rates. And what happened to bonds throughout this entire period? I'm gonna come back to this. I thought I had this in here, but I must have taken it out. Now I'm surprised. So there we go. So bonds, a bond investor in the mid 1940s lost 68% of their wealth by 1981. Okay, now that's inflation adjusted. So let's kind of talk about inflation real quick. So inflation in the United States right now, if you don't know this, you can go to the Bureau of Labor Statistics. You can pull up the last couple of consumer price index reports, but the average price for the average goods that people are buying in the United States right now has been going up about 5.2, 5.3% over the last year. And on the first inflation report, the Fed said this is transitory, this is going to go away, things like that. And now it's starting to be, boy, this isn't looking so transitory. It looks like maybe prices are just going up about 5% a year. The last 2, 3, 4 reports, those are types of inflation numbers are hanging in there. And here's the thing that I want to make really clear that bond investors understand right now. So even if I was using a lot of jargon and terminology and stuff, if I was losing a lot of people, I apologize, because I know this is a little bit more of a complicated situation here when we talk about bonds, but just follow me for this part, because this is the average bond investor in the United States right now. If you own the average bond in the United States, you are generating approximately $14,000 of total annual yield. So between your interest payment of say $25,000 and the average face value that you're going to lose each year because you paid a premium for the bond, you're losing somewhere in the neighborhood of like, say, $11,000 of bond face value each year. You're generating a total return on your investment of $14,000. So you invest $1 million, you're generating $14,000 in total yield on a bond portfolio in the United States right now. Here's the thing though, if we look at a 5.3% inflation rate, that means that $1 million lost $53,000 worth of purchasing power over the last 12 months. So what it took $1 million to buy stuff with, like let's say last year you could buy enough stuff for 20 families with $1 million. This year now you can only buy enough stuff for 19 families with that $1 million. So what I'm getting at, as it's quite obvious here, is bonds are radically underperforming inflation. And it's not possible in this environment when you are paying more for a bond than what you're going to get at maturity. It is not possible for bonds to keep up with inflation going forward, unless you get into a really deflationary environment. So you have to believe that like something's going to change in the economy and prices are all of a sudden going to start dropping really heavily kind of across the board, which, with the amount of federal deficits on the monetary side, the amount of money that the Fed is pumping in, I find it really hard to believe that we're going to get a very aggressive deflationary cycle. And what I'm getting at is bonds are just not going to protect your purchasing power. Bonds just can't get the job done. And by the way, if you're paying 1% a year in fees, you're also down another $10,000. So what I'm getting at is if you have $1 million, that $1 million had to make $63,000 for you to just have maintained your situation, for you to maintain the amount of stuff you can buy, maintain the amount of time that money's going to last you. That $1 million had to make $63,000 over the last 12 months for you to just be in the same situation. And if you were in bonds were actually down over the last 12 months. They're actually down year to date. And and I'm just saying, like from an overall level, if you just go out and type in your bond investments and look at them year to date, look at them over the last 6 months, over the last 12 months, over the last 2 years, you're going to see a lot of not good graphs. You're going to see a lot of graphs going down and to the right. And that's the environment we're going to see in bonds, especially as interest rates start to creep up, as the Fed wants to get inflation under control. Bonds are going to be left in a very, very precarious situation where, we're already starting from a level where they can't keep up with inflation, and there's a whole bunch of interest rate risk. Meaning if you have a bond right now that's only going to pay you, say, 2% in interest, and it's also going to lose 1% a year because you paid more than the face value for it. So again, real simple numbers. You pay $108 for it. They're going to pay you $2 a year in interest, but you're going to lose $8 over the next, let's even just say over the next 5 years, you're going to lose those $8. That's if they don't raise interest rates. So if the Fed gets nervous about inflation and they start increasing interest rates or anything like that, bonds are going to actually take losses, so that your bond that you paid a premium for is now going to trade at a discount if interest rates go up. So the final kind of note that I want to leave everybody with here, as always, we really pride ourselves on education. So the thing that I want to get across here, I know I went kind of fast because we try to keep these a little, try to keep them under a half hour, keep them punchy, but there's some numbers in a bond portfolio that are super critical. So here's a couple of them. Number one, do you know your yield to maturity? Okay. This is the rate of return for a bond investor. This is the number one. So if someone said, what do you think my bonds are going to do going forward? All I need is the yield to maturity. And we have a pretty good idea, that barring defaults, things like that, this is probably about how your bonds are going to do between now and when they start maturing. So do you know that number? Do you know your yield to maturity? The coupon rate, that is only the payments coming in. That doesn't account for the fact that the average bond in the US right now is at an 8% premium. So you're going to lose 8% worth of face value while you're getting those interest payments. So you got to count the whole thing. Yield to maturity takes that whole number into account. So you got to know your yield to maturity. The next thing, do you know how much money you're really making on your bond portfolio? So even though you're getting coupon payments coming in, Do you know the starting value of your bond portfolio, the ending value of your bond portfolio? Do you know if your bonds are actually up? Because again, year to date, a lot of bonds are really struggling, and we haven't even really gotten into big interest rate increases yet. So my next question, if you're a bond investor, do you know your real yield? Do you know the yield that you're getting relative to inflation? And of course, that's a little bit of a setup question, because we know bonds right now don't offer real yield. They are returning interest rates that are below inflation. So they are a guaranteed step away from your goals. A bond portfolio right now for the average investor in the United States is not moving you towards goals. It's moving you away from goals. This is just what we're seeing right now in the current market conditions. My next question is, do you know your duration? Do you know how long on average your bond has until maturity? Because most people that own bonds, they don't own individual bonds generally. They own bond portfolios. They own ETFs. They own mutual funds. They own bonds inside of like target date funds. And they don't know. And here's the thing. If you go over to a Morningstar or Yahoo Finance or any of that type of stuff, you can usually look up that duration really quickly. And that duration is a really good rough proxy for how much money that bond portfolio will lose for every 1% increase in inflation. It's not perfect, but it's really close. Meaning if your duration 6.5, if interest rates go up 1%, your bond portfolio will lose 6.5% of its value. So that duration is a really, really key number to know as a bond investor. The next question, do you know how much your portfolio stands to lose if the Fed raises rates? And again, the reason we keep bringing this up is the Fed is now starting to talk about raising rates. The other day, there was actually a pretty good economic report and the market traded down. And I had a couple of clients call me and go, what's going on? And it's all about the Fed. So if the economy looks strong and continues to grow quickly and be profitable, the Fed is going to have pressure to raise interest rates to try to cool off inflation. And that is going to hurt bond portfolios. And then finally, as always, do you know what you're paying in fees? Fees are already devastating. When you look across an entire portfolio, fees are often the number 2, number 3 expense for somebody in retirement. Usually taxes are number 1. Eric talks a lot about that, and he's right on. Taxes are number 1, but usually investment fees are up there in the top 5 expenses that somebody has. So I want to just really make this hit home for you guys, because I'm very passionate about this. This is the type of thing, when I sat down to write my 3rd book, The New 60/40, one of the things that Eric told me is, he goes, you got to write about things that make you angry, because those are the things you care about. And those are usually the things that you think are, big injustices going on out there. And this is the type of thing, the reason I get so fired up is because I think it's just wrong. But I want to go through the numbers here. So let's say that over your entire portfolio, again, not bonds, but bonds, stocks, real estate, everything you have, everything you own, let's say you're going to get a 7% long-term growth rate on that portfolio. So if you invest $1 million for 30 years and you only pay half of 1% in fees, your money's basically going to grow at 6.5% over the 30-year period. Your $1 million, if we don't take any withdrawals, your $1 million grows to $6.6 million. And then the next line below that, if you invest that same $1 million for 30 years and pay 1% in fees, so pay double the fees, so you're now only earning 6% net on your money only grows to $5.7 million. And I'm laughing now because I just noticed that I did the math wrong on this. It says a $1.1 million impact, but that's a $900,000 impact. That 1.1 number is incorrect. Let's go in here and change this right now. This is a $900,000 impact on a $1 million starting value. So think about that for a minute. The impact of a 0.5% fee over a 30-year period is almost worth as much as the account. That's crazy. And that's a situation where a lot of times when we look at fees, we're also looking at it relative to the value. So it's possible that an advisor that charges 1% or 1.5%, they might be worth 3, 4, 5% a year. Okay. But if they're not tax planning and they're not doing a whole bunch of other stuff, it's hard to make the case that they're worth $900,000 over the next 30 years. So if you're unsure of your numbers, if you'd like someone to analyze your bond portfolio, here's what I would do. We have a contact us page on the website. Go ahead, schedule a strategy session. You'll talk with me directly, and we'll just look at the portfolio. We'll just look at, hey, here's your duration. Here's how much money you stand to lose if interest rates go up. Here's your yield to maturity. Here's, the fees you're paying, all that stuff. Cause this might seem like it's a whole bunch of work, but if you give Eric or I your statements for 5 minutes, we can tell you all these numbers. We can tell you the fees. We can tell you the, yield to maturity. We can tell you the average premium you're paying for bonds right now. We can tell you the coupon rate you're getting. We can tell you all these things really, really quickly. If you just share that information. So again, we're not saying, hey, this is not a, we know you're probably happy with who you're working with and all that type of stuff. But if you really are just curious about the numbers and go, man, I want someone to take a look at my bond portfolio, what I would say is just go ahead and schedule a strategy session at no cost, no obligation. You're not committing to paying us. You're not committing to moving any money. You're not committing to any of that type of stuff. All you're committing to is learning about your portfolio. We'll tell you some information. It'll be helpful information at a bare minimum. It's good information that you can go back to whoever you're currently working with and ask them some really informed, intelligent questions about your bond portfolio, maybe make some adjustments. This is just one of those things that I get really, really angry about because there's so many people that just don't understand how their bond portfolio works. They don't understand the risk of if the Fed raises rates, what could happen to their portfolio. And they don't understand the fact that if you own a 60-40 portfolio, so if you own a portfolio, 60% stocks, 40% bonds right now, you are accepting a loss on 40% of your money. You are accepting underperforming inflation, moving away from your goals, possibly even taking significant losses if interest rates actually go up. You're taking all those risks with pretty much certainty. You pretty much know that all those things are going to happen with almost half of your money. And that's just why I get a little bit excited about this stuff, because it's quite frankly, it just pisses me off a little bit. But anyway, I want to leave this on a positive note. So thank you guys all so much for being a part of this. Thanks so much for being a member of our group, Retirement Mastery on Facebook. If you're watching us on YouTube, thanks so much for subscribing. Make sure you hit that subscribe button. We're going to have a lot more investment content coming out in coming weeks. And, we really appreciate all the feedback we get. It's awesome to see in the YouTube comments and on the Facebook comments and in the chats and different things. We see people talking about how much they're learning through these and on Wealth Wednesday, and also some of the other shorter videos we do, and some of the classes we put on here locally. But I just really want to say thank you to everybody for being part of this community. We're really excited to see where things go here, closing out the rest of this year. And hopefully the market continues surging like it has been. But, at a bare minimum, you want to know where you're at. You want to know what your numbers look like today. And I hope we can just help shine some light on that. And again, I appreciate all you guys so much. Thanks so much for being a part of all this. And, if you have any questions anytime, don't hesitate to reach out. That's what we're here for. Take care, guys.